Welcome to another swing trading strategies video. In this video, we will learn about stage 2 analysis of Wyckoff trading method. I will be sharing 5 specific rules to help you identify high probability trending moves. Principles discussed in this video can be applied to both trading and investing. In the previous video, we covered how to identify price strength within this range, and in this video, we will cover how to identify these strong trending moves. So let's get started. Now, before we get started, let us first discuss the 3 fundamental laws of Wyckoff trading method that will help you profit from trend. These are law of demand and supply, law of cause and effect, and law of effort versus result. The law of demand and supply determines the direction of trend. When demand is greater than supply, price will rise, and when supply is greater than demand, price will fall. We will use rule 1 and rule 2 to assess law of demand and supply. These rules will be covered from next slide. The law of cause and effect provides insight into extent of move in trend. The first step here is to determine strength or weakness of accumulation, that is when price was in range. We will use rule 4 to assess this and any event pending in market to determine its relevance with price movement. Law of effort versus result provides indication of existing trend change and focuses on taking profits in existing trade. We will be using rule 3 and rule 5 to assess this along with some volume related patterns. Now, as price moves higher with trend, I will be showing you how these 3 laws along with the 5 rules we will discuss will help you identify precise points of entry and points of exit. Now, each step here is important and therefore do watch this video till the end. Let me just take 30 seconds to summarize the most important points we discussed in the previous video. This is for those who missed that video. I will leave a link to that video towards the end of this video. Now, while price is in a range, PS is when price takes preliminary support. SC is when selling climax happens, and this is accompanied with high volumes. AR is the automatic rally which happens after the selling climax phase, and ST is the secondary test, and this happens when price tests out supply near the selling climax region. Spring is when price breaks selling climax lows and then reverses to move out of the range. Jump is categorized as when price moves above the range and starts moving higher. In the previous video, we had studied this price action in detail. In this particular video, we will see what happens when price moves out of the range and starts moving higher. Now, when you finish both these videos together, you will have learned how to identify accumulation in a range and how to be with trend and book profits towards the end. So let us now begin with rule number 1. Remember that we are using rule 1 and rule 2 to assess the law of demand and supply. So the first rule is to keep track of strong bullish candles and weak bearish candles. This is an important step and hence do pay attention. When price starts to move higher, in a strong trend, there will be very few bearish candles. Most of the candles that you will spot will be bullish candles with closing happening towards the high point of the day. You will also spot candles with long tails representing strong demand. Bearish candles, if any, will be relatively narrow in range and will not cause price to retrace much. In the chart in front of you, by the time 15% move was over, there were 31 strong candles and only 5 relevant bearish candles. Now, this is a very simple yet effective way to assess strength of move as it begins. If you spot more demand candles, you can certainly trust the trend more. Most importantly, in the beginning of the move, there should be no strong bearish candles present. Demand should be clearly visible and supply should be absent. Now, second rule to assess law of demand and supply is to look for volume and direction of price movement. Now, as trend progresses, there should be higher volume on the upside. And as price goes into a range, volumes should be lower. Now, what this essentially means is that as price moves higher, traders are willing to put in more money on the upside. Now, this is a very bullish sign because it clearly reflects the bias of market participants. Now, within a trend, when price moves in a range or it moves lower, volume should be on the lower side. This would signify that traders are not willing to unwind their long positions and therefore price is consolidating in a range on back of low volumes. Always remember one thing, that volume reflects the commitment of participants of market, and therefore by studying price and volume activity together, you can assess the strength behind the move and can therefore estimate if trend is going to continue or not. If you look at all the teachings of Richard Wyckoff, price and volume relationship always played a huge role in overall market analysis. Price and volume is foundation of price action trading, and everything else is supplementary information. If you look at the chart in front of you, whenever price has moved higher, it has moved on back of huge volumes. And when price goes into these small consolidation regions, look at the volume when you compare it when price was moving higher. It is clearly on the lower side. Now this is the perfect relationship between price and volume that you should look out in every chart you want to trade. Now we will be using rule 3 and rule 4 to assess the law of effort and result. This law provides indication of existing trend change and focuses on taking profits in existing trade. Now under rule 3, in strongest of trends, first retracement is always sideways. In case a trend begins and retracement is much sharper on the downside, that is at least below 38.2% level, then always look out for more strength in terms of price action and bullish candles. Now whenever trend is strong, price will not retrace a great deal. Therefore, to identify strength of trend early on, always look out for how much price is retracing after running up at least 3 to 5% on the upside. Now in a trend that has progressed much higher, if retracement starts getting more deep, that is below 38.2% and 50% level, always start thinking about profit booking. This is usually a sign of volatility rising in the market. Always remember that as trend matures, there will be sellers who enter the system and start driving prices lower. Therefore, retracement is one of the first indicator that you can use in order to identify the appropriate time to start booking profits on your trade. In the chart in front of you, the first retracement that you see after trend began is insignificant and exhibits trend strength. And as trend progresses higher, retracement starts to get more prominent. Now, whenever you spot such activity on a chart, always start thinking about booking profits or partial profits in your trade. Under rule 4, you measure the underlying momentum by looking at angle at which price rises. Now, whenever you analyze strong trending markets, always look at the angle of price rise. When trend is strong and is more likely to continue, angle of price rise will always be greater than 45 degrees. As a rule of thumb, if price is rising at an angle greater than 45 to 50 degrees, then trend will more likely continue without retracing much. If you look at the chart in front of you, till price was rising above the angle of 45 degree, retracement was not visible as such. The moment price moved below the 45 degree trend line, you can see here that price started retracing a great deal. The law of effort and result directly looks into how much momentum exists in price and how much effort currently price is undertaking to make consistent swing highs. The moment price starts to slow down and starts falling below the 45 degree trend line, those are the precise moments when a trader should begin thinking about taking profits off the trade. Now under rule number 5, you measure the law of cause and effect through volatility and by being aware of economy in general. You don't have to be an expert in fundamental analysis though. Now let's recollect the third law of Wyckoff trading is the law of cause and effect, which provides insight into extent of move in trend. Now let's not forget that there has to be some fundamental shift in the market for a trending move to sustain. For example, if economy starts to improve or some long-term policy changes are in place. Now these are the times when trending moves usually develop for many months to come, and which is why you need to always keep in mind the cause and effect of the trending move that is currently underway. Now some examples of such changes would be general elections, Reserve Bank policies, key reforms in economy, or even company specific events. In terms of Wyckoff trading method, the strongest of up moves usually begins with fall in volatility. If you spot a prolonged volatility upcycle and then spot some shift in the economy or market in general, then always look out for trend shift in the market. If price starts moving higher and you see fall in volatility, then always keep in mind that this current trending move could be a long lasting one. On the flip side though, as trend matures and volatility starts rising, you will spot price retracing more, and in this case, you should be looking to book profits. Let us now move to the section of most important guidelines. Now we all know that theory and implementation are two different things. In real life, not all rules will play out like I've explained in these examples. Therefore, within these rules, you need to follow three most important guidelines which cannot be violated. First guideline, at all times you have to look out for price strength. That is, bullish candles should be clearly visible and ratio of bullish to bearish candles should be 5:1 within the first 5 to 6% of the move. Second guideline, first retracement has to be negligible. If you spot price retracing more than 38.2%, then move to the next instrument. Most likely, this won't be the strongest of trends you are into. Third guideline, volatility should fall with price rise. If price rises 5 to 6% and there is no dip in volatility or volatility stays at same level, then always be cautious. Now, in the best of trends that I have analyzed based on Wyckoff trading method, price strength, retracement condition, and volatility criteria are always fulfilled. These three guidelines are cardinal rules which have to be followed at all times. Now let us take up few case studies in order to understand this better. The first case that we will take up is that of ICICI Bank. If you look at this region, price broke out of range here and then progressed higher. You can clearly spot series of demand candles here as price started trending higher. If you also look at the volatility chart here, as price moved up, volatility moved lower. This is a very important criteria, hence always keep this in mind. If you look at this point, this is where price consolidated sideways and then again started moving higher. Retracement criteria that we have talked about in the previous slides gets fulfilled here. Now as price moves higher, over this region you can now spot strong bearish candles showing up. Simultaneously, if you now look at the volatility chart, volatility began to rise as well. If bearish candles increase and volatility increases, you will have to start thinking about booking profits on your trade. Don't worry about missing out on any further up move because you can always re-enter if price shows similar characteristics of what we have seen earlier. Now let us not forget that through this method, you are trying to analyze strong trends early on and then being with those trends till it lasts. In this particular case of ICICI Bank, as volatility started rising and bearish candles started increasing, price eventually started moving lower. Now this is a template that repeats quite often and hence you can benefit from this if you focus on identifying the right things first. So let us now take up a case study of Nifty futures. Again, this is very similar to what we saw in ICICI Bank. Now as price broke out of this region, look at how volatility moved lower. Also look at the series of demand candles that show up which take price higher with momentum. If you look at this region here, the first retracement was almost negligible as price consolidated in a range and then moved higher. Now as price moved higher, volatility started rising, and as this happened, more number of strong bearish candles started to show up. Now based on the rules that we have discussed earlier, whenever you see this combination playing out, always think about booking profit in your trade. If you look at this Wyckoff trading method, foundations of this method is based on the three laws that we studied earlier, along with the importance of strong price action and volatility. This is not to say that we have to ignore all the other rules that we saw earlier, but these three rules of price action, volatility, and retracement at all times have to be followed. Next case study that we'll take up is of Bharti Airtel. Now this case study actually focuses on why you have to ensure that the three guidelines that we just discussed have to be applied at all times. Now in this chart in front of you, this is the point where price broke out of range and started moving higher. Presence of strong bullish candles is clearly evident. If you look at the volatility pattern though, As price has moved higher, volatility has not moved lower. Volatility has more or less remained flat. Also take a note of retracement here. Price has retraced to the breakout point, and while this is not entirely bearish, always remember that in strongest of trends, retracement is always negligible. In this particular example, if you see, volatility and retracement criteria have not been fulfilled. Therefore, look at how trend has progressed here. When compared with previous two examples, clearly trend is on a weaker side in this chart. Now through this Wyckoff trading method, you are first identifying price strength in a range as we saw in the previous video, and then you are identifying strength of trend once price moves out of this range with the rules discussed in this video. Together, these concepts will help you identify and profit from trend better. Now this is a trading system you should follow as it helps you identify strength of price both in range and while it is moving higher. Now I have left out time frame here from discussion as every trader prefers a different time frame. But if you want pointers on time frame and instrument selection, then let me know in the comment section below and I will give out my views. So kindly consider hitting the like button and sharing this video if you like the content. Thanks a lot for watching this video guys. Take care and be safe.